The S&P 500 built your wealth, and at a very specific point, one I'm going to name with a real number, it starts quietly working against you. Not because the market breaks, because your relationship with the math changes completely. And most people over 40 never get that conversation until the damage is already done. Here is what that costs you. A man retires at 62 with $1 million in an S&P 500 index fund. Textbook plan. 4% withdrawal. By 2017, 17 years into retirement, the money is gone. Not because he made reckless decisions, because nobody told him the rules had changed the moment he stopped adding money and started taking it out. That story is not an edge case, it is a pattern. And it has a name, a mechanism, and a solution, none of which are complicated once someone actually explains them. That is what this video is. No motivation speech, no abstract theory. The actual framework, with real numbers and real ages, so you can make a decision today. The standard advice you have heard your entire investing life goes something like this. Put money into the S&P 500, keep adding, stay the course, do not panic. And for most of your accumulating years, that advice is essentially correct. The index has returned roughly 10.2% annually for nearly a century. Warren Buffett endorsed it publicly. The math on dollar-cost averaging is genuinely sound when you are putting money in every month. But here is the reframe. That advice was built for one specific phase of your financial life, the accumulation phase, the phase where you are adding money. The phase where a market crash is actually good for you, because you are buying more shares at a lower price. The sequence of returns in that phase works in your favor. The moment you cross a specific portfolio threshold, and I will give you the exact calculation, the physics invert entirely. Market drops stop being opportunities and start being emergencies. The same index that built your wealth becomes the instrument most likely to undermine it. Not X. Why? Not the S&P 500 is bad. The S&P 500 is wrong for your current phase. That is the reframe. And everything in this video flows from it. The 4-8-12 rule. I am about to walk you through is a three-part framework that tells you what replaces the S&P 500 as your primary engine. Not by removing it, but by repositioning it inside a structure built for where you actually are right now. Rule number 4. The concentration problem. What you think you own versus what you actually own. And I want to start with a fact that will change how you look at your brokerage statement. As of late 2025, the 10 largest companies in the S&P 500 represent nearly 41% of the entire index by weight. Think about that. You believe you own a diversified slice of 500 American companies, but 41 cents of every dollar you put in goes to just 10 names, and those 10 names are overwhelmingly concentrated in a single theme right now: artificial intelligence. NVIDIA, Alphabet, Microsoft, Broadcom, Apple. 5 stocks accounted for 45% of the index's total returns in 2025 alone. 5 stocks, not 500. Here is the deeper problem. The market cap weight of those top 10 companies is running about 10 percentage points ahead of their actual earnings contribution. In 2025, those 10 names represented 41% of index weight, but only about 32% of its earnings. That gap between what the market says they are worth and what they actually produce, that is where the risk lives. The S&P 500's effective diversification has collapsed to the point where it statistically behaves like a portfolio of 54 stocks, not 503. You are holding what the label says is a broad index, and what the math says is a concentrated technology bet. And we have seen this pattern before. Industrial giants in the 1970s and 1980s, technology in the late 1990s, financials in the mid-2000s. Every generation believes their version will not reverse. That's the trap. Rule number 8. Sequence of returns. Risk, the math that only becomes lethal. After your portfolio crosses a threshold. And this is the mechanism that destroyed the retirement plan I described at the opening. When you are accumulating wealth, the order in which your returns arrive is completely irrelevant. A 50% crash followed by a full recovery produces the identical end balance as a strong gain followed by a crash. The math is symmetric when no money is moving in or out. The moment you begin withdrawing, to supplement Social Security, to cover living expenses, to fund the retirement you spent 3 decades building, that symmetry shatters. Now the order is everything. A bad sequence of returns in the first 5 years of retirement while you are pulling money out forces you to sell more shares at depressed prices. Those shares are gone permanently. They cannot participate in the recovery. Your withdrawal rate, which started at 4%, climbs towards 6% without you changing a single behavior, and the ratchet tightens every year. Let me be direct about that. The man I described at the opening, call him Richard, retired in January 2000 with $1 million. He withdrew $40,000 annually, adjusted for inflation. The S&P 500 dropped 49% between 2000 and 2002. Then 2008 hit. The annualized return for that full decade was negative 0.95%. By 2009, his portfolio sat at $455,000. By 2017, it was gone. Meanwhile, a portfolio that held the same S&P 500 core but added small cap value and international exposure grew to $1.2 million over that same decade, despite identical withdrawals. Same starting point, same withdrawal amount, one portfolio empty, one portfolio doubled. Stop for a moment. Before we get to Rule 12, drop one word in the comments right now. Your single biggest blocker when it comes to your portfolio. Is it confusion, fear, inertia? One word. The Trip to Wealth Google Sheet is linked below this video. It gives you the actual framework in your hands. Now let's get to Rule 12, because this is the part most people watching never reach. Rule number 12, the tax architecture layer, the silent cost that never appears dramatically but compounds relentlessly. Ben here. The third reason the S&P 500 stops being your optimal vehicle after a certain threshold has nothing to do with market performance. It is invisible on your brokerage statement. It shows up as a slightly smaller number than you expected at tax time, every single year, forever. It is called tax drag. The S&P 500 currently yields approximately 1.3% in dividends annually. On a portfolio of $500,000, that is $6,500 in dividend income every year, automatically taxable in a standard brokerage account whether you asked for it or not. For higher-earning individuals, add the net investment income tax of 3.8% on top of the standard rate. At certain income levels, your effective rate on those dividends reaches 23.8%. Nearly a quarter of your dividend income gone automatically every year without a single transaction on your part. Now compound that damage over time. A 1% annual tax drag on a $500,000 portfolio costs you approximately $170,000 in lost compounding over 30 years. That is not a rounding error. That is $18,000 per year in retirement income you never see. A $1.5 million portfolio generates close to $20,000 in annual dividend income at that same yield. Nearly $5,000 of that goes to taxes before you touch a cent. Here is the solution, and it is called asset location. Dividend-heavy, high-turnover assets belong inside your 401k, your IRA, your Roth, tax-sheltered space where dividends compound without annual taxation. Your taxable brokerage account is where you hold growth-oriented, low-dividend assets that appreciate without generating ongoing taxable income. Two investors with identical portfolios and identical returns can arrive at retirement with meaningfully different balances based entirely on which assets sit in which accounts. That's the entire playbook for tax efficiency at this stage. Now, my friend, let me give you the psychological layer underneath everything I have just told you. Because none of this is actually about discipline. It is not about whether you are financially motivated enough or whether you check your accounts often enough. If you have been doing exactly what the standard advice told you to do and something still feels incomplete or off, That feeling is correct. You were following a framework that was designed for a phase of life you are no longer in. That is a diagnosis. It is not a character flaw. The architecture you were never taught is this. There are 3 distinct floors of portfolio evolution, and the S&P 500's role changes on every single floor. Below $200,000, pure simplicity wins. Keep adding, automate everything, do not complicate it. The rocket is still on the launch pad. Between $200,000 and $600,000, you are in the transition zone. Sequence risk begins to matter. Tax drag begins compounding meaningfully. At this floor, you add a small cap value tilt. Historically, one of the most well-documented sources of excess return in academic literature, and a moderate international allocation that holds ground when U.S. large cap enters a down cycle. Above $600,000 approaching and beyond $1 million, the tax conversation becomes the primary lever. Asset location, uncorrelated return sources, and genuine diversification are the difference between compounding aggressively and quietly handing a portion of your gains to the government each year. Here is the one diagnostic rule that tells you where you stand right now. Take your expected annual spending in retirement, multiply it by 25. That is your target retirement portfolio using the standard 4% withdrawal framework. Now look at your current balance. If you are already at more than 50% of that target number, you are inside the window where sequence risk can be existential today. Not when you retire, but today. Because the market correction that damages you most is not the one that happens in retirement. It is the one that happens while you are still thinking about whether to adjust. For most people watching this video, that threshold lands somewhere between $350,000 and $600,000. That is the exact window where your portfolio is large enough to be hurt, but not yet positioned to absorb the blow. And here is the current context that makes this urgent. The Shiller-Cape ratio as of early 2026 sits near 39.9. That is the highest reading since the year 2000. A CAPE at that level has historically been associated with materially lower expected forward returns over the following decade, not a guarantee, but a directional signal that the cushion built into standard withdrawal models begins to erode. Your wealth system should be structured to run and protect itself through market cycles without requiring you to make emergency decisions under pressure. If it cannot do that, it is not a system. It is a hope. Stop for a moment. One decision sits at the end of this video, not 10. Not a list of habits to build. One structural decision. Are you going to keep running the accumulation architecture, the same rocket you launched from, into a phase that requires completely different mechanics? Or are you going to build the system that matches where you actually are? Here is what that looks like in concrete terms. First, calculate your sequence risk threshold right now using the formula I gave you. If you are past 50% of your retirement target, the mitigation starts this week. Second, keep the S&P 500 as your core but reduce its share of total equity exposure. Add a meaningful small cap value position. Add 15 to 20% international developed market exposure. Not because international always outperforms, but because when U.S. large cap enters a lost decade, diversification means you do not lose everything at once. During the lost decade from 2000 to 2009, international small-cap stocks alone delivered over 190% in total returns. The same 500 companies in an equal-weighted structure returned 5.1% annualized, while the standard cap-weighted index produced negative 0.95%. Third, act on tax location before anything else. Move dividend-heavy assets into your tax-sheltered accounts. Begin holding growth-oriented, low-dividend assets in your taxable account. My friend, the S&P 500 is not broken. It is phase-specific. It was the right rocket for launch, but you do not land a rocket the way you launched it. The investors who understand that early enough are the ones who arrive at retirement with options, the ones who do not find out when it is too late to adjust. If this breakdown brought you clarity, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. Thanks for watching. I'll see you in the next one.